So joining me now is David Struzeski, CEO of Sound Planning Group. That's an insurance firm building client retirement strategies. Thanks so much for coming on the show. Another day, another roller coaster on Wall Street. We had dipped into the red a few times, but they were short-lived losses. What do you make of today's activity?
Well, today's activity is kind of interesting. Always, when we see these big declines, we're going to see bounces back. I think if we track or chart anything going back to 2008, the year 2000, we see positive time frames. Now, what's interesting today, though, is that I was checking the Federal Reserve's monitoring of what they believe rate hikes are going to look like. And so rate hikes are really the thing that are driving our market right now. They're really the thing that are, of course, driving the price of our stocks, our real estate, and even our bonds. But look at what they just did in September. They went from 50 basis points as an expectation back to 25. And so that's the type of accommodations that we're looking for if we're going to see a stock rally. And so, of course, if they begin to have more of a dovish type of position, that's going to be incredibly valuable in changing PE ratios. And I would say get poised for a massive growth opportunity if analyst expectations are correct, given that 95% of the S&P has been in and 75% of them have beat expectations. NVIDIA would be my expectation. They're going to do the same as well. So things seem to be very positive.
Yeah. David, certainly that stock catching a bid today, outperforming the broader market. So I think the investor sentiment is there as well. And we should know, really, it does seem as if investors are buying the dip today if they do have a long-term view, because retailers were a mixed bag. I mean, Urban Outfitters had a bad report, yet the stock up double digits today. So people clearly coming into this market amid the recent pullback. So much so that based on your rate comment, it is surprising to me that the Fed indicated in these meeting minutes that it could hike interest rates even more than originally projected, yet the stock market ending with solid gains. Does it seem like a buy the dip kind of day, and do you think the rally can last?
Great question. I think that's the million-dollar question, right? And so as we're in the middle of things, it's difficult to predict in general, but now we're in the middle of many different headwinds coming at us. So the Fed's saying that it's willing to do whatever's necessary. That's a good sign, right? Because we want to see them being willing. If they say that they're not willing, that would be, of course, very negative. So I'd say that was a positive. The next part here with the Fed is just to note that, hey, they actually did just make that adjustment in September. So for the fact that they would come out with a strong statement to say, hey, don't look at that as weakness. They're just, I think, looking at inflation and saying, we think that there's some easing taking place in inflation. So is it a buy? Well, I guess what? If supply comes back, that's been one of the biggest drivers for inflation, over the last 2 years. And that would be really important. So let's get some ports moving, some things going. But there's some great opportunities here today if analyst estimates are correct. But you asked the question, can they continue for the long term? So, I mean, I could make the case today for at least a 20% upside to the S&P, and then in certain areas better than 50%. But I can also make the case to say that there's a lot of negative headwind, and that analyst estimates and consensus estimates need to look at a recession in the future, and they probably need to pull down what their estimates are. And so if they do, that means that they way overestimated. That would be really bad. So I guess we're going to see what happens as the time of this thing plays out. Will the Federal Reserve do a splashless landing? Is this going to be a belly flop? I hope it's not, it's probably neither one. It's probably something in between. Let's hope for the best, cross our fingers. But we're in the middle of that inflationary environment, and the middle-class families are really feeling it right now.
I think a lot of groups are really feeling it, certainly probably the middle class and those looking at their retirement accounts as the stock market has cratered, David, from recent highs at the start of the year. And that's my next question. Your firm helping put a retirement planning process in place. What are you advising your soon-to-be retired clients right now?
Well, it's all about understanding your personal situation from risk management, liquidity, We've got to have time horizons, different targets that we're looking at meeting. And so we do income planning. And obviously, it's very difficult right now for retirees or baby boomers in general to be looking at retiring today when the market's at record highs and it's really kind of waffly right now. We've got inflation at a rate that how do we even project that over the length of a retirement plan, 30 years or so? And then we look at, interest rates on things like bonds that are yielding historically a third of what they've done, with the potential of those increases from the Federal Reserve, which of course would again tank those bonds. So yes, we do see better yields today, but still those yields are far below what we're seeing for real inflation. And so what we do is we help people to come together, understand true Roth conversion plans, true Social Security maximization. Those two things right there, blending your income together with a combination of ordinary income, your capital gains, your tax-free dollars, and ultimately some of these things like Social Security and pensions, you can minimize the yield that you need to gain in order for your plan to work out, because you can minimize taxes as an example or do things more efficiently. So we have a really unique niche. We're growing massively and helping a lot of families to do it. But more importantly, this type of planning seems to be very rare in this world right now. But in a time when people need real answers, I don't know how you'd want to go forward in the future without it.
So another question that I have is, you're right, I think scary for some people to retire at this very moment, not just because the stock market is down 20% on the S&P, 30% on the NASDAQ, and people may see, right, their retirement savings, their life savings cut by a third. That's not easy to see, but there's still so many uncertainties out there. Will we have a recession? How long will it last? How long is China's zero COVID tolerance policy going to last? How long will supply chain issues persist, right? The list goes on and on and on. And so for your clients, are you advising them, if they can, to hold off simply on retiring because of the current state of the market?
Well, that's certainly an option. I think, though, that as we look at the landscape of America and the baby boomers right now, we had the Great Resignation happen last year. So there's many people that are in retirement and they're doing this thing. So about 50% of boomers today have approximately retired. But true story, Social Security and Medicare today are approximately 60% of all federal spending. That's a very big number. So there's some challenges to that as well. Are there going to be some reforms? COVID actually even shortened the years of when Social Security is supposed to be insolvent, and Medicare Part A as well. We'll get more on that July the 1st when their board meeting notes come out. But where people are today, yeah, what do we advise? So we've built and refined a process of how we manage risk and we look at things. And so one of the areas that we want to have specific attention to today are our protected assets. Where do we go? Right? So CDs yield nothing. We're going to lose to inflation significantly. Bonds are losing to inflation right now. And if you own bonds, you're down significantly this year. We do not have a significant allocation to bonds in our firm. In fact, what we use is a lot of alternatives. And so there are alternative asset classes that give you the ability to have reasonable rates of return, great protection on the downside, superior to what bonds would provide, because there's not guarantees in bonds. Bonds can lose money, 5 different ways. And so the point is that people need to be aware of what their options are. And from that standpoint, then they evaluate risk tolerance time frame. Hey, buy low, sell high. I feel like a lot of people right now are looking at this and saying we're a little bit, maybe optimistic, but cautious for sure, as the rest of our life depends on this thing. So
buy low, sell high with caution. I like that. David Strzelecki, CEO of Sound Planning Group. That's an insurance firm building client retirement strategies. Thank you, David. Stay with us because we're going to have NVIDIA earnings out any moment here. Of course, I want to get your take in the wake of those.